Welcome to the deep dive. We're here to take complex stuff, break it down, and hopefully pull out some really fascinating insights for you. Today, we're jumping into something that impacts international business, travel, even your own finances sometimes, foreign currency risk. We've got some great material to help us figure out what that risk really is, and more importantly, how to handle it. Now, before we get rolling, just a quick reminder, this deep dive is based on material from Farhat lectures. All the content, the examples, the explanations, it's all derived from the resources over at farhatlectures.com. So if you're an accounting student, CPA candidate, or already a professional, you should definitely check out the website. They've got extra practice questions, video lectures, loads of support to really nail down today's topic. Big thanks to Professor Farhat for providing all this. Okay, so let's unpack this. The mission today, to get you comfortable with understanding foreign currency exposure and the tools, things like forward contracts, futures, options that businesses use to, well, manage that risk.
Yeah, to sort of hedge their bets.
Exactly. Think of it like getting a peek behind the curtain of global trade, seeing how companies protect themselves. All right, let's set the scene first. We'll mostly be looking at things from the viewpoint of a U.S. company, maybe doing business with someone in Europe or, say, Canada. And what's really interesting here is how the strength or weakness of the U.S. dollar can just completely change the financial picture.
Absolutely. That's really the crux of it. You first have to figure out which side you're on. Are you expecting money in or are you sending money out? That determines your risk. Let's maybe look at two core scenarios. First, what happens if the domestic currency, the US dollar, appreciates? It gets stronger.
Okay, stronger dollar.
Right. Well, if you owe money in a foreign currency like euros or Canadian dollars, a stronger dollar is good news for that liability. Your US dollars buy more of the foreign currency, so the payment becomes cheaper. Great for importers.
Ah, okay, so importers like a strong dollar.
Generally, yes, for their payables. But it harms accounts receivable. If you're expecting to get paid in, say, euros, and you convert those back to a stronger dollar.
You get fewer dollars back.
Exactly, fewer US dollars, so bad for exporters in that sense. And you see this ripple out, right? Cheaper for US folks to buy foreign stuff, more US tourists heading overseas because their dollar goes further.
All right, I see that connection.
Now flip it. What if the US dollar depreciates? Gets weaker.
Okay, weaker dollar scenario.
Everything reverses. This time, it benefits your accounts receivable. If you're getting paid in euros, those euros convert into more US dollars because the dollar is weaker.
So exporters are happy then?
They usually are, yes. But it harms accounts payable. If you owe euros, your weaker dollar means it costs you more US dollars to make that payment. That hurts importers.
Got it. More expensive imports.
And for consumers, foreign goods cost more. But maybe you see more Europeans visiting the U.S. because their currency is relatively stronger. It cuts both ways, you see.
So it really boils down to knowing if you've got this net asset exposure, you're owed foreign money, or a net liability exposure, you owe foreign money.
Precisely. Let's make it concrete. Think about Adam, a U.S. company buying materials from Canada. Adam owes 1 million Canadian dollars, CAD, due in 60 days.
Okay, so that's a clear liability exposure. He owes foreign currency.
Exactly. And this is where you can really see the risk in dollar terms. Let's say today the spot rate, the rate right now is 1 US dollar equals 1.35 Canadian dollars.
Okay.
To cover that 1 million CAD, Adam needs about 740,740 US dollars right now. Just divide the million by 1.35.
Simple enough.
But what if in 60 days the Canadian dollar strengthens? Say the rate moves and 1 US dollar only buys 1.2 Canadian dollars.
Uh-oh. That sounds bad for Adam.
It is. If Adam hasn't done anything to protect himself, that same 1 million CAD liability now costs him 833,333 US dollars.
Wow.
Yeah. Just divide the million by 1.20 this time. That's an extra cost, a potential loss of nearly $93,000. $833,333 minus $740,740 just from the currency moving against him.
Ouch. That's a significant hit, almost 100 grand just vanishing.
It really highlights that liability exposure risk.
Okay, so that $93,000 potential loss, that's definitely going to keep someone up at night. What can Adam actually do about this? How does he hedge this risk?
Right. So with a liability exposure like Adam's, the big fear is the foreign currency. The CAD getting stronger, appreciating, making his payment more expensive in USD terms. The goal is to limit that payout. Put a ceiling on the maximum USD he'll have to spend. There are a few main ways. The simplest, maybe, is just buy the currency now. If Adam has the $740,740 USD today.
He could just buy the million CAD right away.
Exactly. Lock it in, risk gone. Peace of mind. Even better, maybe he can invest that CAD for the 60 days if he earns, say, 1%.
The net cost comes down slightly.
Right, maybe to around $733,405. Of course, if he doesn't have the cash, he could borrow the USD to buy the CAD now, but then he's got interest costs to think about. You have to weigh that.
Okay, so buying now is one option. What else?
Well, then you have forward or future contracts. These are basically agreements to buy the CAD at a specific rate on that future date when the payment is due.
So you lock in the rate beforehand.
Precisely. Forwards are usually private deals with the bank, futures are standardized, traded on exchanges, but the core idea is the same, locking in a price. Adam might pay a broker a fee, let's say $20,000 to lock in a rate of maybe 1 USD to 1.31 CAD.
Okay, so slightly different from the spot rate today.
Often is, yeah. This guarantees Adam pays exactly 763,358 USD for his million CAD. That's 1,001.31. Compare that to the potential 833,333 laws if the CAD strengthened to 1.20 without a hedge.
That solid protection provides certainty.
Does. The downside is if the CAD actually weakens, say to 1.40, Adam still has to pay at the locked-in 1.31 rate. He misses out on the favorable move.
Right, you trade flexibility for certainty.
Which brings us to the third main tool, call options. A call option gives Adam the right, but, and this is key, not the obligation, to buy the CAD at a set price, the strike price, by a certain date.
So it's like insurance. You hope you don't need it, but it's there.
That's a great way to think about it for this scenario. The point is to limit the maximum payout. If the CAD appreciates, which is bad for Adam's liability, his option to buy CAD at the lower strike price becomes valuable, offsetting the increased cost of his liability.
Okay, how does that work practically?
So Adam might buy a call option. Let's say the strike price is 1 USD to 1.25 CAD. He has to pay an upfront fee for this, right, called the premium. Let's say the premium is 0.005 per CAD.
Okay, strike price 1.25, premium 0.05. So what's his actual protected rate?
You add the premium cost to the strike, so his effective break-even, or his maximum rate, is 1 USD to 1.30 CAD. 1.25 strike plus the 0.05 cost makes it effectively 1.30. This means he's capped his payment at $769,230 USD. 1,000 CAD, 1.30.
Got it. So he knows the absolute most he'd pay is that 769K figure.
Right. Now let's see how it plays out. Scenario 1, CAD weakens. Let's say it goes to 1 USD equals 1.50 CAD.
That's good for Adam, unexpectedly.
It is. He wouldn't exercise his option to buy at 1.25. That makes no sense. He lets the option expire worthless. He loses the premium he paid.
But he buys the CAD on the open market.
Exactly, at the much better 1.50 rate. So he only pays 666,666 USD. He benefited from the favorable move minus the small cost of the option premium.
That's the flexibility you mentioned.
That's it. Now, scenario 2. CAD strengthens. This is what he feared. Say it goes to 1 USD equals 1.6 CAD.
Okay, the option should help here.
Definitely. The market rate is terrible for him. Buying 1 million CAD would cost over $909,000 USD now, but he has his option.
So he exercises it.
He exercises his right to buy at the effective rate of 1.30 strike plus premium cost, paying his capped amount of $769,230 USD. The option saved him a huge amount compared to the unhedged market price.
Wow, that really shows the power of options. Protection when you need it, flexibility when you don't. Okay, that makes sense for hedging a liability. Let's flip the script now. What if Adam was selling to Canada, expecting to receive 1 million CAD?
Ah, yes, the asset exposure scenario.
The whole risk profile changes, right? Now he's not worried about the CAD getting stronger.
He's worried about it getting weaker, depreciating. If the CAD weakens before he receives it and converts it back to USD, he gets fewer dollars than he planned for.
So his goal is the opposite. He wants to guarantee a minimum amount of USD, put a floor under his receipts.
Precisely. He wants to protect his income, ensuring he gets at least a certain amount of US dollars for those Canadian dollars.
Okay, so how do you set a floor? What can Adam do if he's expecting to receive foreign currency?
Well, again, a few strong options. One, maybe the simplest if possible, is sell the receivable, also known as factoring.
Just sell the invoice, basically.
Pretty much. Adam could sell his 1 million CAD receivable to a bank, probably a Canadian bank today. The bank gives him the USD equivalent now based on today's 1.35 spot rate, maybe $740,740 minus their fee, and they take on the risk of collecting the CAD and the currency fluctuation.
Quickest way to get the cash and eliminate the risk entirely.
Yes, but you usually pay a fee or get a slightly less favorable rate. Second, just like before, forward or future contracts. But this time, Adam enters a contract to sell his 1 million CAD at a set rate on the future date he expects to receive it.
Locking in the selling price for his CAD.
Exactly. Maybe he pays a fee, say $25,000, to lock in a selling rate of 1 USD to 1.30 CAD. This guarantees he receives 769,230 US, 1.30 euro. He knows exactly what his CAD will fetch in USD, no matter what the market does.
Again, certainty over flexibility.
Correct. And finally, the option strategy here is a put option. A put option gives Adam the right, but not the obligation, to sell his foreign currency, the CAD, at a specified strike price.
So a call option is the right to buy, a put option is the right to sell.
You got it. This creates that floor he wants. If the CAD depreciates, which is bad for his receivable, his put option to sell CAD at a higher price becomes valuable, offsetting the loss on the receivable itself.
Okay, let's use the same kind of numbers.
Sure. Adam could buy a put option with a strike price of, say, 1 USD to 1.25 CAD. Let's use the same premium cost, 0.05 per CAD.
So strike 1.25, premium 0.05. What's the effective floor rate here?
For a put, you subtract the premium cost from the strike to find your minimum guaranteed rate. So 1.25 strike minus 0.05 premium gives an effective floor rate of 1 USD to 1.20 CAD.
Meaning he's guaranteed to receive at least
833,333 USD. 1,000 CAD, 1.20. That's his safety net.
Okay, let's run the scenarios again. First, the bad one for Adam. CAD weakens significantly. Say 1 USD equals 2.0 CAD.
Oof. Without the put, his 1 million CAD is only worth $500,000 USD.
Disaster.
But he has the put. He exercises his right to sell at the effective floor rate of 1.20.
So he gets his guaranteed 833,333 USD.
Exactly. He lost the premium, sure, but he saved himself from a massive loss on the receivable value. The put did its job perfectly.
And the other way, what if the CAD strengthens, say 1 USD equals 1.2 a CAD?
Now, this is good news for his receivable. The market rate, 1.2, is much better than his put option's floor rate, 1.2 in effective.
So he wouldn't exercise the put.
No way. He lets the put option expire, loses the premium he paid, but then he sells his 1 million CAD on the spot market at the favorable 1.10 rate.
He gets
$909,090 USD, much better than his 833,333 floor. Again, he captures the upside while having had downside protection.
Wow, okay. It's really clear that this isn't about predicting the future market. It's about identifying your specific risk, are you paying or receiving, and then choosing the right tool.
That's exactly it.
Forwards, futures, calls, puts, they all offer different trade-offs between certainty and flexibility.
Absolutely. The key takeaway is always, first, understand your exposure, liability or asset. What direction of currency movement hurts you? Then, pick the hedge that fits your goal. Do you need absolute certainty, forwards, futures, or do you want protection plus the chance to benefit if the market moves your way? Options.
That flexibility of options seems particularly powerful.
It can be, yes. It allows you to manage risk without necessarily locking yourself out of potential gains.
This whole deep dive really shows how being informed about these tools can turn what seems like a huge, scary risk into something manageable, something predictable.
It takes the guesswork out of it. It allows businesses to focus on their actual operations, not constantly worry about currency swings eroding their profits.
Transforms a potential headache into just another managed part of doing business internationally.
And this makes me wonder, beyond just the immediate financial protection, how might really understanding and strategically using these hedging tools actually open up new international opportunities for businesses?
That's an interesting thought. Could it make companies bolder about expanding globally?
Maybe. If you know you can manage the currency risk effectively, does that influence your long-term strategy? Does it change where you decide to source materials or sell your products?
Something for you to think about as you continue your own explorations into global finance. Until next time on The Deep Dive, stay curious.